Chapter 2, Accounting for Partnership, Basic Concepts. What are the elements will be studied here is going to be discussed now. Block number 1, we have to understand the preparation of P&L appropriation account. P&L appropriation account. Along with the capital account, in capital account we have two models. Fluctuating capital account and fixed capital account. So these are the two models we have. And that too, apart from this, we have to prepare past adjustments. This will be the block 1 for your understanding. Clear? In the basic concept chapter, we are going to discuss this in detail. Apart from that, subsequently you are going to learn about the reconstitution of firm, which is nothing but admission of a partner, retirement of a partner, as well as admission and retirement, finally death of a partner. So these are the 3 varieties or 4 varieties we will be discussing in the case of reconstitution of firm. And then the third concept is all about winding up of the business, which is called dissolution. We will study that separately. So these are the 3 aspects are going to be covered in partnership in detail. So P&L appropriation account and past adjustments will be discussed in the first block, past adjustment. Right. Assume that if it is a sole proprietorship, whatever the mode the owner gets it from the business is meant for the owner. Even the net profit is also for the owner. Net profit is 10,000 rupees, directly addable with the owner's fund. If owner says, sir, there is a salary for me 5,000, from the net profit deduct 5,000 should be addable with the owner, remaining 5,000 should be addable with the final value of the capital. So the final value of the capital remains same, there will not be any changes at all. I hope so you could understand. But when it comes to the partnership firm, assume that A, B, C are the 3 partners. In the previous lecture I have given that they plan to start a business called Furniture Mart or Fun Mart. This is how they named it. All the 3 partners contributed capital, not only capital, otherwise A contributes more fund, B contributes his contacts, and C contributes physical support. So physical contribution. Because of running this business, they get net profit. Whatever the net profit they get, first of all, these 3 contributors demand as per their own contribution some benefits, right? If they are accepted to distribute the profit as per their own contribution made in the deed itself, that should be in the deed, will be distributed accordingly. If it is not so, then Partnership Act will come. If the deed is silent, we have seen in the previous class. Here we assume that there is a proper deed for distributing any benefits as per their own contribution. So in this net profit, A will be given as he is more contribution, he is supporting with more fund contribution, he is getting interest, and B has supported with the contracts and he is given the commission, and C is being the physical contributor, he will be given salary contribution. After that, whatever the balance left over will be shared among the 3 partners as per their own P&L ratio accepted, else equally distributed. I hope so you could understand. This process will be carried over separately. For example, you might have studied the final accounts, right, in your early studies. So trading and profit and loss account, and where you will be getting net profit here. This net profit will be given to the partner, means owner. Okay. So owner's capital account, with that this net profit is added. If only one owner being there, then no problem, by whatever the way he shares the net profit is meant for the owner itself. But in this case we have multiple partners, multiple members, and each and every member contributes differently, then the problem arises not to give this value directly to them, it should be given differently. Now let's see here how should be a capital account appears here. This net profit will be transferable to a new account called P&L appropriation account, which is for the sharing, and then the way how it is shared will be given to the owners, which is called capital account. The capital account most probably will prepare in columnar form. When the ledger accounts prepared in columnar form means when the common ledgers will have equivalent items in the debit and credit side for all the accounts, then we will prepare in columnar form. Here we have three partners assumed to be, assumed in this case we have assumed that we have three partners A, B and C, right. So they start with their own capital, and for their contribution they are getting interest on capital, salary, commission, everything will be addable. Ultimate profit should also be addable there, and these things are from this value, right. That is why this block will come, or two accounts will come, P&L appropriation, capital account will come, and finally balance sheet is prepared. If it is a sole trade, directly the net profit is added with the capital, but in the case of partnership firm, that net profit will be distributed to the different partners as per their own contribution. So we are giving this effect by preparing these two accounts, P&L appropriation account and capital account. Let me prepare here. So this block I am going to prepare, right. So here trading and P&L account, okay. Here profit and loss appropriation, P&L appropriation account, okay, appropriation account prepared. What will you get in P&L account? You get the net profit. That net profit is transferred here, net profit, right. Then I need to prepare capital account. I am going to prepare the capital account here, capital account. Under the capital account we have a column, so columnar form, three partners. So for the three partners I have three columns here. In the debit side as well as in the credit side I have the three partners, three columns. So A, B and C, A, B and C, three columns, right. Capital usually liability side, is in the liability side, so the balance will appear in the credit side. So by balance brought down for A, for B, for C, we have the balances in the credit side. Now each and every partner contributed for the firm, no, they demand something. That demand may be interest, commission, salary. We have to offer them. Assume that C is eligible for salary, I am offering the salary. So whatever the amount we offer them will be addable, means it should be credited in their books itself. So I am crediting to C, and B is offered with the commission, so I am going to credit the commission for B. So commission for B. All the partners contributing capital but differently, as per their own contribution they are eligible for interest on capital, should be credited in their account. So interest on capital, okay, for all the three partners, I have given this also, interest on capital, okay. This one. Balance will be again distributed if there is profit. Of course I am going to distribute this to these three partners, right. I have given all these things, okay. So partner has invested the money for the business, physical support and contact support, for their capital some benefit, for the risk taking ability or support they are given the profit share. So all these things are given, and these partners are saying that we are running our business completely without taking care of any other work. So to run my family I need money, so now and then I will withdraw some money from the business, could be adjustable later. So whatever the amount they have withdrawn will be now recorded here. So two drawings, A has drawn, B has drawn, C has drawn. So all these drawings are recorded here. Whatever the ultimate balance you get, that balance will be balance carried on. As you have invested the money, capital, you demanded interest. If you are withdrawing the money, you have to pay the interest, right? So I am collecting the interest, means the firm collecting interest from the partner. So interest on drawings, right? So these are the values are going to be charged in their book. This will be the ultimate adjustments we have to carry over before distributing, before closing the books of accounts. If only one owner, no problem. If multiple owners are there, whatever the net profit will get, this net profit will be given to these three partners as per their own expectation, agreed in their own deed itself. I hope so you could understand. Now, if there is an expenses, what is journal entry? Expenses to cash. Finally, the expenses debited to the P&L account. Entry will be P&L account debit to expenses, right? Let's see here. After that, of course, we can prepare the balance sheet here. I leave this at time being. I don't consider that part here. Now let's see here. For the expenses, what is journal entry? For the expenses, the journal entry being expenses account debit to cash, and that expenses is debited to the P&L account. For that, the journal entry will be P&L account debit to expenses. These are the two entries are passed. But whenever you are offering something to the partner, those things, what are they? Salary, commission, interest on capital, debit to, not immediately giving that in the form of cash. We are recording their own account. So to capital account, and these items not debited to the P&L account, but these items are debited to P&L appropriation, because not charge. Charge means expenses. Appropriation means sharing. It's not expenses. So I am going to share this. So I am recording that in the P&L appropriation account to salary, commission, interest on capital. That's how I can post here. Means this entire block will come here. To salary given to C, and commission given to B, interest on capital given to all the three, A, B, C. Similarly, they have withdrawn. For that, interest is recoverable. This block will come here. This block will come here. Okay, then I hope so you could not understand. And this block will go to this place. So interest on drawings. Under that, for A, B, C, I have just posted here. Finally, if I tally whatever the balance I will get, that is the profit meant for the old partners. That means partners in their own P&L ratio. So this entire thing will be credited in their account. This will be debited in their account. Whatever the balance you get is called balance carried down, will go to the balance sheet as capital of A, B, C. Capital of A, B and C. This is how we can do it. So from the trading and P&L account, you get the net profit transferred here. The net profit is distributed to the partners as per their contributions over. Now, that's all. Okay, now how to pass a journal entry? I am going to explain the way of passing the journal entry here one by one slowly. Now, come on, tell me, where from this net profit comes? This net profit comes from the trading and P&L account. So the journal entry for this is P&L account debit to P&L appropriation account. Profit and loss account to profit and loss appropriation account. This is the ultimate net profit in the P&L account transferred to the P&L appropriation account for the distribution to the partners. Each and every partner demands something. What A demands, what B demands, salary and commission. So salary account debit to whom this one is meant for? C is capital. So simply you can name this as capital account. Which capital account? Respective partners capital account. That's how we can write it. Respective capital account. Salary account debit to capital. Where the capital of salary account will go? Usually salary expenses means salary to cash, and then that salary will go to the debit side of the P&L account. Here the salary will not go to the debit side because it's a sharing. Sharing means sharing account should be there, which is nothing but P&L appropriation account. It should be debited to the P&L appropriation account. So P&L appropriation account debit to salary. That's how we can do it here. I hope so you could not understand this one. P&L appropriation account debit to salary. This is how it is over. What about the commission? The same way. So rather than writing again, I name it as commission. Salary or commission, whatever it may be, that will be debited and to the respective partners capital account. Then later P&L appropriation to the salary and commission. Of course, you have to repeat the same for the interest on capital too. So interest on capital account debit, interest on capital account debit to interest on capital account debit to partners capital account. So to partners capital account, and next one is this interest on capital account should be transfer to the P&L appropriation account. So P&L appropriation account, debit to interest on capital account, I hope so you can understand the second one. So we have completed this one. Keep the profit later because ultimate balance is transferable. We are not aware about it, so keep it pending. Now interest on drawings, just a reverse of this one. So capital account debit or respective capital account debit, we are charging them, right, to interest on capital account, interest on drawings account. Clear? I hope so you can understand the interest on drawings account. Over. If you tally this, whatever the balance you get, the profit is meant for the owner. So the entry will be P&L appropriation account debit to partners capital. Directly you can pass the. So okay, this one should also be transferable to the P&L appropriation account. So for that the entry will be P&L appropriation account. Sorry. Okay. Interest on drawings account debit. To P&L appropriation account, okay, I have posted this, and the profit, ultimate profit, P&L appropriation account debit to partners capital account. So P&L appropriation account debit to partners capital account for the distribution of final profit. So we have done all these things. Is it clear? I hope so you could understand. This is the method you have to follow. So beforehand we have trading and P&L account, after that we have the balance sheet. Now we have discussed only this block, P&L appropriation and capital account have been discussed here. And the P&L appropriation is clear. In capital account, the method what we have followed is called fluctuating capital account. Means the opening balance, because of so many adjustments, the balance what you get ultimately will be totally different, gets fluctuated. Then the partners wants to know what is their original investment they did at the time of commencement of the business. Because of so many adjustments after 10 or 15 years later, no one knows how much we have around 15 years ago if they don't maintain the financial reports for the 15 years. Definitely we cannot maintain the records for 15 years, then the problem arises here. So they want to maintain a separate record for the original investment, and the rest of the things for the tentative changes we have to maintain separately. That will come under fixed capital account. So in fixed capital account, the original capital investment made by them remains as it is. Whatever the adjustment we do will be recorded in a new account called current account. So I am going to make a slight change here to make you understand the difference between normal fixed capital as well as fluctuating capital method, right? So here, let's see here, capital account and current account So I have two accounts, splitted that into two accounts, okay, three partners A, B and C, and here too we have three partners A, B and C, three partners. Clear? The original capital will be here. So by balance, opening balance brought down. All the rest, that opening balance what I have posted here will not be recorded here. That will go to the capital account. Okay. Then it will be tallied. No adjustments is done here except two, which is nothing but further investment for the expansion. Further investment or further capital for the expansion, or drawings against capital. Okay, they find the huge capital is there, huge fund remains unutilized for the business purpose, wanted to reduce their capital by withdrawing that will come here, rest of the things will not come here. And whatever the balance you get is called current account balance, will be the opening balance in the next period. So balance brought down of the current account. So such a way we have two sets here. One is current account, another one is original investment. So original capital will be totally different, current account is totally different. Current account is active. There will be inflow and outflow will be always happening in the current account, not here. So capital account is separate and current account is separate. So we have two accounts here. So when the current account comes, it is very simple that the original capital account will be kept separately and rest will be separately done. So in this case, the salary is usually debited, means transferred to the capital account, right? So here it's not capital account. Here in this situation, current account will come. Here in this situation, current account will come. Remember, current account will come. Okay, current account will come. Clear? So under fixed capital model, the transferable value will go to the current account. I hope so you could understand the slight difference between fixed capital and fluctuating capital method. Let's see a summary of the difference between fixed capital and fluctuating capital methods. So fixed capital method and fluctuating capital account. Fluctuating capital method, right? Point number 1, number of accounts. How many accounts are there? Number of accounts. In fixed capital we have 2 accounts, in fluctuating we have only 1 account. Okay, in fixed capital we have current account and capital account. In the case of fluctuating we have only 1 capital account. Number 2, change in balance. Okay, balance, change in balance. In fixed capital will not change, fluctuating capital will change because the opening capital remains as it is except in 2 situations. And what are the situations? And in the case of further expansion purpose, if any investment is made, or if the capital seems to be exorbitantly heavy or high, not required to be used, then they can withdraw from the capital, could be a reason for the reduction. And third one is where do you make the adjustments? In the case of fixed capital account, all the adjustments are made there itself. In the case of fixed account, we don't do any adjustment. That adjustment part will go to the current account. Fourth, balance type. So balance type. In the case of fixed account, we have capital account as well as we have current account, 2 accounts. Capital account will always be credit balance, and the current account may be debit sometimes and may be credit sometimes. So the current account may be debit and credit, but in the case of fluctuating, almost all the time it will be credit balance for your understanding. So these are the 4 differences you can keep in your mind for the better understanding. I hope so you could now understand this summary for the entire first block preparation. Past adjustments of course we will discuss later.